Hello, everybody. Welcome to our 1031 Tax Deferred Exchanges webinar. This is a recorded webinar with Millcreek Commercial and South California Exchange Services, and we're so excited that you guys are joining. As we have people kind of filing in for the webinar, I'd just like to let you know, this webinar will be recorded and available for your download after the webinar. We will send out a link to everybody that has registered. We will get started in about 1 to 2 minutes after we have everybody in. But without further ado, I will turn the time over to Spencer Taylor of Millcreek Commercial to welcome you all. And we're excited to learn and get a lot of more great information on 1031 exchanges today. Spencer, I turn the time over to you.
Thanks. We'll just give it a few more seconds as people trickle in. Okay, welcome everyone. We sure appreciate having you here on this webinar. As Parker mentioned, we're here with Megan Destito, owner and operator of Southern California Exchange Services out of Camarillo, California. Megan, welcome.
Thank you.
How's the weather? How's the weather down there?
It's beautiful and sunny. Today's supposed to be a high of 75.
Probably just like every other day of the year.
The nights are a little chilly.
Sure. We're excited to explore the kind of the intricacies of 1031 exchanges, rules, dates you need to be worried about, and then really talk more about how to use this in your portfolio for your clients, for yourself, and talk a little strategy on using 1031 exchanges to benefit you and your portfolio. We have a Q&A feature at the bottom of the screen, and we want to get to every question. Even if we go over the hour we have slotted for this webinar. So please, we'll answer all your questions. Please submit those in the Q&A feature. So with that, Megan, should we get started?
Let's do it. So,
hi, everybody.
Thank you. Thank you for that introduction. So for our conversation here, I just think it's best to just start at the very basic. So I will really explain what the 1031 exchange is, and then we'll gradually talk about the process. And then, like you mentioned, I definitely want to talk about more complicated scenarios when it comes to an exchange, and then talk about ways that an exchange benefits you besides just tax deferral. So how I like to think of an exchange like a real estate ladder. Like, how do you work your way up that real estate ladder using a 1031 exchange to do that? So an exchange, which is part of the Internal Revenue Code, Section 1031, it's actually been around for over 100 years. And I feel like it hasn't really changed significantly during that time. I just feel like the gray areas, the really gray areas, some of them are less gray. A lot of it is still based on interpretation. And so I just want to preface this conversation by saying that I am not a tax advisor. I do not wear that hat. I'm not an accountant and I'm not an attorney, but I know enough information where I can give you suggestions on different points of view, if you will. So back to the 1031 exchange conversation. It allows real estate investors to defer paying capital gains tax on both a federal and state level, as long as they're reinvesting all of those proceeds into another real estate investment that's equal or greater in value, and that's considered like kind. So we come to this term like kind or like for like, and I want to say it's probably the most misunderstood term within the whole 1031 exchange conversation. And I feel that most people assume it to mean condo for condo or house for house, and that's not how you should interpret that. It means investment property for investment property. So we're talking about real estate asset for real estate asset. So as long as you are reporting it for tax purposes as an investment property and proving yourself to be making income on it, and you're not using it for personal use, more than likely it qualifies. So types of properties that do qualify, well, of course, we're talking about our single family residences. We have our condos, we have our homes. It doesn't matter if your tenant is a long-term tenant or a short-term tenant. It all depends, like I said, on how you are reporting that property to the IRS. We have our multi-unit properties. So we're talking about a duplex, a triplex, a very small apartment buildings. Those qualify. Now, if you live in one of the units and rent out the other units, the units that you rent out would be available and qualify for exchange treatment. The unit that you're using is under a completely different section of the statute, which is section 121. And so in this scenario, I just want to explain it really quick because you might have a question like, how does that work if I'm selling the property as a whole? So let's just say it's a duplex and it's equal. You live in one unit, you rent out the other, and it's 50-50. If you were to sell that unit as 100%, you would get your unit under section 121, which means that if you're filing as a single person, you can defer up to $250,000 of that gain. And if you filed married, then you can defer up to $500,000 of that gain, as long as you've lived in that property and reported it as a primary residence for 2 of the last 5 years. And they don't have to be consecutive. At least that's my understanding. So if you were to sell the property, you get that exclusion for a primary, but then with the rental, you can set up a 1031 exchange. So your 1031 exchange would be set up as an undivided 50% interest of 123 Main Street. And you can take that 50% and invest it into an investment property over here, where eventually you may own 100% of that. So vacant land, of course, that qualifies, even if you're not producing income on it. The fact is that you've been holding it as an investment, and of course, you're not using it for personal use. Farmland, of course, that goes without saying. And then we go into commercial real estate, which, you know, is Millcreek right here. So I think it's an amazing option for anybody, but especially those within a 1031 exchange, because you can buy pieces of these amazing assets where you can earn passive income. You don't have to deal with a landlord. You're getting a great return, which could be doing better, well, much better than the stock market right now. And you're in it for the long haul. So it's a great avenue for an exchange. And then you have these securitized real estate deals, which they're referred to as DSTs, but they stand for a Delaware Statutory Trust. And they're securitized, meaning that you have to go through a financial institution like a financial broker in order to get into something like this. But let's just say that it is a trust. A trust owns like an apartment building. They call it a sponsor. And anyone who's investing underneath that trust is a trustee. And they receive a benefit from that asset, which is the apartment building, which means that they're also getting more than likely a monthly dividend. And so these, both commercial real estate and these DSTs are great options, especially if you're in a time crunch and you're trying to find replacement property to satisfy your exchange and you're not finding that perfect residential property. These are readily available all over the United States. It's just a matter of connecting with the right broker or the right financial advisor in order to get into that, which, you know, I'm happy to help anyone with. Then you have your less known assets like oil and mineral rights, which doesn't come across my desk too often, but I just put it on here because it's something different. And it's kind of thinking a little bit outside the box, but it does qualify. What doesn't qualify, of course, I mentioned your primary residence. You have your own exclusion for that. Property held for resale. We're talking about people who flip real estate. So they are considered a dealer of property. They are not a long-term investor, which means that the property and the taxpayer wouldn't qualify or receive the benefit of a 1031 exchange. Then you have your vacation homes. So the general rule of thumb is if you have a second home and you're using it for personal use, but you're also renting it out, the general rule of thumb is that you want to use that property up to 2 weeks for personal use or it's 10% of the allotted time that you plan to rent it out. So if you're renting it out and 200 days out of the year, you are safe to use the property for 20 days and report it as such, and it will qualify for exchange treatment. Anything technically above and beyond that doesn't qualify. Of course, you have your stocks, bonds, mutual funds. Those are not real estate assets. They don't qualify. And then I just want to explain REITs, because REITs, even though they're securitized and they're a real estate asset, it's just the way that they're structured doesn't work for 1031 exchanges. Sure, you can get into them, but it's difficult to get out of them, and they just aren't very liquid.
Hey, Megan, can I ask a question on that slide real quick? So two questions. Number one, does the property have to be earning like rental income or earning other income for it to be considered like an investment property? And then number two, what's been the most unique or most interesting exchange you've seen, like selling one property for a different type of property?
So to answer the first question, it really boils down to how you're reporting the property. So if you're holding it as an investment, but it's not receiving income, is there a paper trail to show why? Like, can you prove that you've been marketing the property to show that it's an income? Like, are you trying to get tenants in there? So I think it depends on that scenario. And then your next question about my most unique exchange. It really varies. So I have people that are consolidating, they're going from several investments, buying into one, but then I do have others that diversify. So they might go residential and do something with Millcreek or a DST. So there's different ways that you can do that, or they might eventually buy with another partner. So they're still satisfying their exchange, but they're buying in an investment with a friend. So yeah.
Good. I mean, kind of an example that I see that, like, on the extreme, you can sell an apartment complex in downtown LA and buy farmland in nowhere, Oklahoma.
Right.
Like, that qualifies. They're like kind investment real estate for investment real estate.
Right. Yeah. So that's the thing that I find that kind of fascinates me, because a 1031 exchange seems so rigid, but there's so many areas where it is really flexible. There's so many different ways that you can structure one deal. So you can either make it very complicated, or you can make it very streamlined, very easy. You can do a condo for a condo, or, you can take one investment and start branching out and buying multiple investments and buying different types of investments. So that's the part that I like, is just the strategy.
Thank you.
So the people that benefit from the 1031 exchange are the investors, if you will, that are in it for the long haul. So like I mentioned earlier, if someone is flipping real estate, they look like a dealer of properties. They're not considered a long-term investor. So what determines a long-term investor? And even though I feel like this is a gray area of the statute, and it is still kind of based upon interpretation from your own tax advisor, I would say that there's enough court cases that have set the precedent. So you want to make sure that you've at least owned and reported the property for a minimum of 1 year. So ideally, your minimum, I would say, to play it safe, is 2 tax years. So you've reported it and held on to it for at least 2 tax years, to make sure that you're looking to the IRS like, I was in it for the long haul, but now I'm going to exchange up into something else. So you want to make sure that the property that you're relinquishing has been held for long term, and you want to make sure that you're showing that the property that you plan to buy and replace is also going to be held for long term. So you need to go in with the mindset like, I plan to hold on to this and report it for at least another 2 years before I decide to do another exchange. If you sold it outright within that time frame, it doesn't matter, because you're paying your taxes to Uncle Sam. But if we're talking about down the road and we're thinking about the next step, you want to make sure that you've satisfied the exchange on at least this front. So most people go into a 1031 exchange because their intention is to defer 100% of the capital gains tax. But you can defer less than that. And it just means that it's not jeopardizing your whole exchange by you doing that. It just means that you have a taxable event on something. And I'll explain that here. But if your intention is to defer all of it, then you want to make sure that you're crossing every T and dotting every I. They say that that's staying within the safe harbors of the exchange. So you want to make sure that you're following those parameters to a T. And the first one is that you want to purchase another property, an investment property, that's equal or greater in value than what it is that you just relinquished. So if you relinquished $1 million property, you want to look at another property valued at $1 million. Granted, you can deduct closing costs and interests from that transaction, and that's the real value that you can be looking at without jeopardizing your exchange status. But for the most part, I just like to say that just keep it straight across the board. If you had a loan on that property that you paid off, say it was a $500,000 loan, you want to make sure the property that you are buying, you're replacing that debt with the same amount. So you want to acquire and take on another $500,000 loan to satisfy the debt requirement. And then any proceeds that's being held with the QI, the qualified intermediary, that's me, those all need to be reinvested into that replacement property. So it's equal or greater on 3 fronts. And once that sale closes, that's of course when your exchange clock starts. But I want to talk about that 45, you have 45 days. They call it a 45-day identification period. You want to make sure that you are identifying what it is that you think you're going to buy within that 45 days. Now, you can be in contract on a property within that 45 days. If you're not, then I need to have a letter in my file that's saying, these are the properties that I am looking at that I intend to use or to buy to satisfy my 1031 exchange. So if you have done that requirement, then you have an additional 135 days to fulfill on that obligation. So your exchange time period is a total of 180 days. And I'll explain more and get into the specifics about that 45-day, 180-day in just a second. But your last requirement, which is very important, is that you want to make sure that the entity that is selling is the same entity that is buying. So if you are selling your property in a trust and the husband and wife as trustees, that's a trust. In the eyes of the IRS, that's one taxpayer, same taxpayer. And you want to make sure that the property that you're replacing is also going to be the same entity and the same taxpayer. So in that scenario, you would want to make sure that you'd be purchasing this property in the trust. So an example of where it gets a little bit complicated is if you own title to the relinquished property, but it's in a partnership. So the partnership is the entity, and maybe you have 5 members within that partnership, but not everybody wants to do an exchange. Some maybe just want to cash out. So if you know that, then you need to work with legal counsel to make sure that you're dissolving the partnership so that each person can take on their own undivided interest in that property. And then from there, they are able to move independently. So that takes planning and that takes time. So do not come to me with your exchange saying that, oh yeah, by the way, I want to move independently. No, that might take a month or 2 for an attorney to figure that out and to do it correctly so it doesn't jeopardize your exchange. So back to
kind of a note on that, Megan. If you approach your QI early and often, communicate early and often with your QI, hey, we're thinking of selling, or hey, we just got under contract, we close in 90 days or 120, whatever. And this is what we're thinking about doing. Your QI can walk you through. Yes, you can do that. No, you can't do that. Here's, and so just ask your questions early and communicate kind of your intention. And then there's never a hiccup.
Right. I think, yes, I agree with you 1,000%, because I feel like the best clients are the ones who are most prepared. So I even had a gentleman who is thinking about relinquishing a property a year from now, but he wants to gather as much information that he can now to figure out what he's going to do down the road. So yes. And the reason that I love this conversation is because it's so much easier to get into an exchange if you have a plan.
Right.
So if you don't know where you're investing those monies, that 45-day window seems like it's 2 days. It just, speaking from personal experience, it's stressful. It's stressful if you don't know where you're going.
Yeah.
And it's a lot of money that you're talking about. So yes, having a plan and being in communication, the more information that I know, like you said, the more I can be like, you might want to get advice on that. Or definitely I know that you can't do that. So yes.
Or let's tweak your plan just a little bit. So, someone might come to you and say, oh, we're selling this headache apartment complex and we want to buy a cabin in the woods.
Right.
Great. I know what your question is, Megan. Well, how do you intend to use it? We want to use it for family gatherings and one. Okay, that's not an exchangeable transaction, but if you use it as a VRBO or a rental, and you talk about this 10% rule, right? Then they can realize, okay, here's how we have to do it and complete and fulfill the requirements of a 1031 exchange. And now you can move forward versus buying something that doesn't qualify and then having to pay the tax when you weren't expecting to pay the tax.
Absolutely. So I had a client call me, and so she had a couple of investments that she was hemming and hawing about relinquishing, and her kids had moved on. They don't come back and visit her. So she's like, well, maybe I should just buy this, sell these, exchange them, and into an area that I would like to eventually live.
Yeah.
But she didn't want to be a landlord. And so I said, well, there are other options besides residential real estate that you can consider. She had no idea. So I mentioned your company's name, and she was like, and she eventually purchased with you, but she wasn't even thinking that. She was thinking about just consolidating and then just buying another property, and then she'll manage that. But in her heart, that's not what she wanted. She wanted to just have something passive and not have that headache of dealing with tenants anymore. So she eventually went in the commercial real estate realm because it was a great option for her. But if I hadn't asked those questions, then she probably would have bought another residential property.
Yeah. So talk early, talk often, over communicate as
communication
as you kind of walk through this, right? Yeah.
Yeah.
Good. Thank you for those tips.
So going back to those 3 factors that I mentioned earlier, I just want to elaborate on the debt portion. So in that scenario where you're buying the $1 million property and you need to take on the new $500,000 loan and reinvest those funds, if you did not want to take on the obligation of another $500,000 loan, you can reduce that debt requirement, but that means that you have to bring in your own money to offset that debt. So if you wanted to take on only a loan valued at $400,000 instead of $500,000, you can do that, but you have to bring in $100,000 to the closing outside of the exchange. So you can always offset the debt requirement by bringing in your own money. There's never an issue with that. The IRS loves cash. The only thing that they don't want you to do is to take on too large of a loan, and then you're pocketing any of the proceeds that your QI is holding on your behalf. Now you can do that, but if your goal is to defer all of the gain, then you want to stay clear of that, because the portion that you're pocketing, they refer to that as boot, and that boot is taxable. And so when you're in an exchange and you're thinking about pulling cash out, you need to think about the chunk that is going directly to the IRS, because maybe it doesn't make it worthwhile to actually pull the cash out. So in California, you might be paying 30, close to 40% on that money. So maybe that doesn't make sense for you to even take the money out. It would be better spent. You'd make more money if you kept it in the exchange and reinvested it.
Yeah, good. Thank you.
Sure. So the exchange, every exchange has a timeline, and that starts the day that your sale transaction closes. So I mentioned that we have that 45-day identification period. And then from then we have the additional 135 days to close on that. But within that 45-day window, like I said, if you're not in contract on that, then you need to give me a letter in writing. And I want that letter to be specific. So I want you to list it like, these are the properties that I'm identifying to satisfy my exchange. Here's property A with a full address, 1, 2, and 3. Let's do 1, 2, 3. Then you're signing and dating it. And so that needs to be in my file to me. And I say to me because that's who you should be sending it to, but really it's anyone to the transaction. But if I don't know that you've identified, what sense does that make? So I'm just going to say it needs to come to me. And so I just want to make sure that you understand that there are no extensions with the 45-day rule. So if it falls on a weekend or a holiday, that still needs to come to me by midnight on that day. So it's a calendar day. It's not a business day, it's a calendar day. So, and it's the same thing with your 180th day. So if you are past your 45th day and now it's creeping up and you're near the 180th day, because closing offices, attorneys, escrow companies, they don't operate on the weekends. So if your 180th day falls on a weekend, you have to make sure it closes by that Friday. If it closes on Monday, you have a failed exchange. You did not satisfy that requirement. So you need to make sure that you are well aware, what's my 45th day? What's my 180th day? Can I do it? I have to do it if I want to defer any of the tax. The only time that you would ever get an extension on your exchange is if the property or someone involved in the transaction was involved in the natural disaster. So if you were part of the California flooding that happened recently, that was declared a natural disaster. So you would be allotted an extension on the 45 days and 180 days. And if that pertains to you, you really need to talk with your tax advisor to say, like, what do I need to do? How much time? Like, what does that mean for me? So I just wanted to, because it is relevant, unfortunately, for many people in many states. I mean, the hurricanes in Florida, so it's unfortunate, but you do have time extensions. So with the 45-day letter, there are 3 guidelines that you need to abide by, and you're only choosing one of the three. So if you're drafting your letter, most people fall within this 3-property rule. And the 3-property rule says that you can identify up to 3 properties where there's no limitation on the value of each of those properties. You can interchange this letter with these properties up until the 45th day. So whatever letter you have in my file on that 45th day stays with me for the duration of your exchange. And hopefully you are purchasing something from that identification list. Then you have, if you want to identify more than 3 properties, then you're either in the 200% rule or the 95% rule. And the 200% rule says that you can identify more than 3 properties as long as the values of all that you're identifying on that list does not exceed 200% on the value of what it is that you relinquished. So if you're going above and beyond the 3-property rule, now you need to start doing math. Right? You need to probably at this point work with your tax advisor to say, does this work? What if I don't do that? What are the tax liabilities that I have if I don't fall within that category? So, and then if that 200% rule doesn't work for you, then you're in the 95% rule. And the 95% rule says that you can identify more than 3 properties as long as you're purchasing at least 95% of what it is that you're identifying. Most of my clients are either in the 3-property rule or they're in the 200% rule. Very rarely are they in the 95% rule. Maybe they are if they know that they're only buying specific DSTs. So they've done the math and they know exactly the percentages, but more than likely you're in the first 2.
And these rules, kind of to sum it up, these rules allow you to go from one big sale to many little purchases. or many little purchases up to one big one, like you sell a lot of different single family rentals and you buy a apartment
Right.
complex, right?
That's where it gets a little bit complicated, which I'm going to touch on in just a second. So
Yeah.
if we're talking about one property for one property, the 3-property rule, it's more than likely it's going to satisfy what you're trying to do. But yes, if you have multiple sales and you're looking to diversify those sales, then your identification list can get a bit complicated. So you want to make sure that you're crunching the numbers to make sure that you have enough value or that you're not exceeding your value over here. And it's not my job. I can tell you, like, I don't think those numbers work for you. This is something that you need to work with your tax advisor, your accountant, to make sure that you're abiding by. And this is another gray area within the 1031 exchange realm, because I have had clients that did correctly identify, and then they moved past the 45th day. And so they wanted to purchase outside of the 1031 exchange, the identification letter. And you just need to know that that's a risk for you. So that's a risk because it's not properly identified. So it all boils down to, are you going to get audited? Did you cross your T's and dot your I's? And the IRS will look at the identification letter and then the closing statement to say, these addresses do not match. What happened here? Why did you do what you did? And you better have a clear paper trail that shows your intention, that you try to get property A, B, and C, and you couldn't, and that property D was available. And, so I just want to make sure that you understand that if you go outside of that safe harbor, that's a risk, and it could be a major risk.
Yeah.
So I've had these conversations come up very recently, where I have people saying, I have a couple of investment properties that I'm considering relinquishing in a 1031 exchange, but how does that work for a 1031 exchange? Like, is it multiple files? So can you explain that to me? So if you have a couple of investment properties, then it really boils down to the timing. And this is where things can get a little bit complicated. So if you have property A and the tenants are moved out, it's ready to be listed, it's ready to sell. And yet you have property B where the tenants are still in there perhaps, but you're hoping that you can put them together because you want both of those funds, both of those transactions to buy one big property. Like, that's what your intention is. So if property A closes, that's going to start the exchange timeline for that file. If you want property B to be included with property A, it needs to fall and close within that 45-day window. And the reason is, I need to know the complete value of what it is that you relinquished in that one file so that I can let you know whether or not you're meeting your obligation of purchasing a property that's equal or greater in value. So you only have a 45-day window for multiple sale files to be included in that one initial exchange. If property B doesn't do that, that's okay. It just means now you're opening up another exchange file, and that has its own timeline. Now, maybe these two files still are able to purchase that one property. And what I mean by that is maybe you have a contingency on that purchase and the seller agreed to that. So the seller agreed, like, we will keep an extension on that property so that both of these sale closes. And those two properties I know are going to come, and those monies are going to come, and they're going to buy this property from me. I'm okay with that. So that's when this whole scenario would work in your interest. And so property A, for my purposes, let's just say, would be buying a percentage of this purchase property. And property B, for that exchange and for reporting purposes, would be buying a percentage of that property, which means that you're still buying 100%. So if property A is buying 55% of this replacement property and property B is buying 45% of that property, you're still buying 100%, and the entities all match. I just want to make sure that when we're talking about multiple properties, we're making sure that the entities match. So you can see where this can get pretty complicated because we're talking possibly about multiple timelines. We could be talking about multiple purchases, and we also want to make sure that the values work. So if we have multiple exchange files with multiple relinquished properties, are you buying enough value to satisfy that one exchange file? So that's where, you want to make sure that you probably have a chart and you're keeping track.
Spreadsheet.
Spreadsheet, yes. So this is the conversation that I get pretty jazzed about, because it's thinking outside of just what, besides tax deferral, what other benefit does an exchange bring me? And it kind of brings me back to that ladder that I was talking about, because without an exchange, you can invest in real estate at any point in time, but the exchange kind of forces you to go straight up, right? Like you at least have to buy something equal or greater. So every time you're doing an exchange, you're kind of going equal or greater up that ladder. So that's kind of how you're exchanging up. You can start with a condo, that you bought in for $200,000, and maybe today it appreciated to $400,000. So now you're taking that $400,000 investment and you're exchanging it into something maybe $500,000 worth. So, and then, and that $500,000 property is probably bringing in a lot more income than the condo. So now you're not only buying up, but you're increasing your monthly income stream by doing that. And you did that because the 1031 exchange kind of forced that upon you. And you can take that one investment, that let's just use that $500,000 property. And if you decide to exchange that, you can exchange that into two properties. So now you're kind of starting to build your real estate portfolio within your exchange realm. So now you have two assets, and so then these two assets are producing two sources of income, which maybe is greater than what you're receiving on that $500,000 house. And then you can also, with those assets, you can also buy, you can mix it up. So you can go residential and you can also go commercial. So now you not only have two assets, but you have two different types of assets. And so one of them you could be in for the long haul. You could be in commercial real estate with Millcreek, and you're sitting there, eating bonbons on that, receiving the monthly income for 15 or 20 years, loving life. And maybe that's paying for the mortgage on this investment property. So there's so many different ways that you can utilize a 1031 exchange, and you can also invest across state lines. So you can buy in a zero income state like New Hampshire, and therefore you're getting a benefit not only from your exchange, but for tax purposes as well. So it's just thinking outside the box, but almost like planning ahead. Like what does it look like for me? Like, where do we want to go 5 years from now, 10 years from now? Like, we're getting older. I don't want to deal with landlord. I don't want to be a landlord anymore. I don't want to deal with tenants. I would just want it to be easy. So maybe you start exchanging and considering buying into commercial real estate. So it's just, I love that aspect of the conversation.
One thing that's interesting about this is, okay, so let me give my dad as an example, right?
Yeah.
He's like an accidental landlord. So I think I was like fifth or sixth grade. He comes walking in, he's like, hey, we're buying our friend's house, the Purriers. We're buying their house. We're going to turn it into a rental, right? Okay, Dad, why are you doing it? Well, they told us they were moving, and they said, do we know anyone who wants to buy it? And my dad was like, well, I'll buy it. And then kind of over time, my dad's an optometrist. He's about to retire, so he's really excited. Over time, he would just like opportunistically buy neighbors' houses or friends' houses. One time he's given an eye exam, and the patient's like, yeah, I'm going to move. I think I'm selling my house and moving in the summer or whatever. My dad's like talking to his patient. Well, I might want to buy your house, right? So he's accumulated these homes over time. And so oftentimes what we did in terms of an investment in our late 20s or 30s was right for that time in life.
Mhm.
And as things have changed and careers progressed and different values have shifted,
Mhm.
it's time to, I like this, like exchange up, get into something that's more conducive to the lifestyle you want, the income style that
Or
you
consolidate,
appreciate, right? Yeah,
right?
consolidate
Yeah.
or yeah.
Or
Yeah.
yeah, so consolidate or even downsize. Like maybe that investment's way too big for me. It's way too much management over here.
Right.
So maybe I want to do
Too
something that
labor
has,
intensive. Yeah.
yeah.
Yeah. So
Mhm.
things change over time. Our values shift with
Absolutely.
children growing up and then grandkids and then legacy planning and things just change. And the 1031 tool allows for the investment to follow the values, right, that we have. So
Right.
I think that's pretty cool.
Yeah. I mean, again, that's where where the flexibility is. You
Yeah.
know, it just seems like you have to abide by these rules, but yet you can do a lot over here.
Right,
So
right.
yeah.
Yeah.
I had a gentleman call me and he wanted to talk about the term swap till you drop. And he wanted to say, I just don't agree with that statement. You know, I don't think that you have to keep swapping until you die. I feel like you can do it one time and you can even do it by setting yourself up for retirement. So I asked him to kind of elaborate what he thought about that. And I really enjoyed the conversation because he said, my wife and I, we have a couple of investment properties and, you know, we have a nice primary residence, but what we plan to do is exchange those and consolidate those investment properties, but we plan to buy a retirement home, our dream home. And we know that we have to satisfy our exchange. So we are going to rent it out for a number of years because we know that we have to do that. And then after we've met that obligation, we're going to take that investment property and then we're going to convert it and report it as our primary residence. And then that's where we plan to retire. He's like, but I'm not exchanging over and over and over. I'm doing it just one time. He's like, so I'm not even deferring the tax. I'm avoiding the tax. And so I was like, that's an interesting take on that. And I like that. But, you know, and he was even saying that, and then if my kids, you know, if me and my wife, if we pass away in this house, then my kids inherit this property. And hopefully when that happens, they also get a step up in the basis. So they wouldn't be hit with taxes or capital gains if they decided to get rid of the house. And so I was like, he's kind of using a 1031 exchange as like an estate planning tool, you know, a retirement plan. And so I just thought that that was another way that, you know, if you're in like considering retirement and you have investment properties, that is something that you consider. And I just want to say that by converting a property that you already own, that you've been reporting as an investment and converting it to how now that you're using it as a primary, that doesn't trigger a taxable event. You know, it doesn't trigger anything because you own the asset. You're just defining how you're using it. Now, if you wanted to get rid of that retirement home and exchange it, then you have to convert it back to an investment property and start reporting it as an investment property again in order to do a 1031 exchange. But if you sell it as a primary residence, you know, when you've been using it as your retirement home, then you're back to the 121, you know, exclusion, section 121 exclusion. So I just wanted to mention that because I think it's a great way to think about exchanges beyond just tax deferral.
Yeah, good.
And that's really, you know, I feel like we covered a lot within that time frame. So I just maybe time for questions.
Yeah. So let's dive into the Q&A. And just as a reminder, please use the Q&A feature down below to submit your questions. We want to answer all questions. So Dara asks, please talk about reverse exchanges. So this topic is for its own, like,
It really is.
webinar, but could you give us just like high level overview of what is a reverse exchange and maybe one or two things to think about as you're kind
Sure.
of considering that?
Yeah, I didn't even, you're right. It is a whole conversation within itself, but a reverse exchange comes into play when you have found your replacement property, your purchase, before you're even ready to relinquish your sale. So this is complicated. They're convoluted, they're doable. So what happens is that I have LLCs created that have zero assets, they're worth nothing, but they're basically entity holders, if you will. So the client will loan one of my LLCs money. And there's two ways to go about a reverse exchange, but I'm just talking about just the most common. This is usually how it's done. So they loan my LLC the money to buy the replacement property for them on their behalf. So there is no real exchange at this point in time because you, the client, have not taken title to anything yet. I have on your behalf. So if everything works out hypothetical and I'm sitting on title to this replacement property for you, then it frees you up to sell your relinquished property like you normally would in a deferred exchange. And you're using those proceeds from me to then buy my LLC off of this replacement property for you. So the benefit is that you're able to secure this asset ahead of time. The downfall is that you cannot rely on the proceeds from the relinquished property. And the real caveat is the financing. So if you need a loan in order to buy the replacement property, the loan needs to be in my LLC's name, but it needs to be guaranteed by the client. And most lenders right now that I have found they're saying that I will not create this loan for you unless it's at least worth $1 million, and I will charge you a point. So a lot of times it doesn't make financial sense for the client to go this route instead of just trying to keep it simple and do a deferred exchange.
I think just high level there. Number one, it can be done.
Yes.
Number two, call Megan with kind of the specifics, right?
Yeah.
And you can kind of get down in the weeds and really walk through.
Right. There's so many details that we would really have to work through in order to make that happen.
Okay, Jan asks, would be interested in hearing more about personal use within investment property, like a hotel where a couple was living in one or two of the units. And I think, talk to your CPA, but whatever you're using as your
think of it like an Airbnb.
Residence. Yeah.
So
yeah, okay.
I'll speak from personal. My husband and I owned an Airbnb. And so we would go out there for 2 weeks and use it. And granted, we go other weekends to make sure that we were handling, like maintaining the property. But the rest of the time we were reporting it as, an income property. So we're not reporting it to the IRS. Like, we were only there for 2 weeks. But if you were to get audited, the IRS wants to make sure that you're showing a proof of that income. They want to see the books on that property so they could question, like, okay, so I see this whole week here, you received no income. And I saw this whole month here where every other month was completely rented out, but yet the month of March is completely empty. So can you explain that? So that's really what it boils down to, is that you don't want to jeopardize your whole exchange because you decided to, mess with your books.
Yeah. And I think she was also alluding to, okay, I'm living in a portion of my investment property. Okay, that's my primary residence.
Yeah.
And I'm selling the rest of it.
That's where I would
talk to your
defer.
CPA.
So you really want to get a legal opinion on how you should structure that and whether or not they have a stamp of approval on that. That's not for me necessarily to say. Yeah.
Okay. Kevin asks, my family owns a vacation rental property in an LLC.
Okay.
If one of the partners or family member uses the property, we pay a reduced rental rate, right? No single partner uses it for more than a week. Does this property qualify as a 1031 exchange? And can we as sellers invest our proceeds differently, or do we all have to exchange into the same property? going
Well,
forward?
the LLC is almost like a partnership, right?
Mm,
So the
mhm.
LLC is the taxpayer. And
Yeah.
so I don't know that it really at least that's what I'm assuming. So I don't know how they're reporting that property with the members, if the LLC is reporting it or they're,
It kind of sounds like maybe there's 5 or whatever family members.
huh.
They each own a fifth of the LLC,
Oh, I see.
and that LLC as a benefit to the family
Right.
owns that rental property,
Right.
right?
Right. Well,
So
again, I would deflect that over to their legal advisor to say, do you think that more than one member of that LLC, even though they're the taxpayer, could utilize that property for more than 2 weeks out of the year? So I would ask their stamp of approval for that, unfortunately.
Right.
Mhm.
Yeah, that's really complicated. There's a lot more information that.
Right. I feel like I don't have enough on really the structure of the LLC. So I don't feel comfortable really giving a definitive answer for that, unfortunately.
But kind of like, okay, if the LLC is its own entity owned by different family members,
Yeah,
that LLC is paying taxes.
right.
So kind of the last portion of that question is, can we go and do our own thing after we sell? Well, you would need to.
The whole LLC is doing it. Otherwise, you're
Yeah.
dissolving the LLC, and
Right.
each member of that LLC is taking on their own undivided interest. And maybe
Right.
each member, has their own LLC at that point. They can do
Mhm.
that. So there are ways to go about it, but again, I think that it takes planning. So
Yeah. Kim is asking, if you sell an apartment building and purchase a lake house as a VRBO,
Uh-huh.
how much can you use it for personal use? They're
again,
asking, is it 2 weeks? If it isn't rented, can you use it personally?
So again, it's 2 weeks. However, if you're buying an Airbnb that has already been established, then you kind of already know how much it's going to be rented out. So you can kind of gauge from there the 10% of that rental, like I gave before, if it was rented out for 200 days out of the year, 10% of that is 20. So you could use it safely for 20 days, however you decide to use that. For personal use.
And so let's say you're looking at like 2 weeks ahead and it's not being rented Tuesday, Thursday, Friday, right? 2 weeks out.
Yeah.
And even the day before, not rented, not booked. Could you zip out there, enjoy it? I mean, if it's not being,
Right.
used by a client, does that mean it's fair game for you to use it as the owner?
Well, we're just a small group here, right? So it's not for me to say whether or not, sure, you can do that. But I will speak from personal experience that yes, I have done that.
Yeah.
So if I know that there's weekends ahead where it's not being rented, then I have taken advantage of that and I have used it for personal because again, I'm still keeping track of my income coming in, my income going out, and the IRS isn't going to know if I opened the door and stayed there overnight.
Right.
So
right.
it's
it's good to go down there. Okay. Everything in good working order, dishwasher, water.
right, and you kind of write it off like that was a maintenance. Like I didn't use it for personal. I had to go there and maintain the property. So that was part of the business. That's part of ownership. So there is that as well that I think people can take into consideration.
Right.
And like, you're not hearing this from me.
I think the red flag is, okay, it's booked out basically every week, 20 to 25 days a month.
Right.
But there's this 6-week window,
Right.
consecutive weeks, not
Right.
rented out in the prime like rental.
Right. If you're consistently bringing in rental income, then all of a sudden it becomes inconsistent. I think that raises a flag.
Yeah.
So don't raise a flag.
Robert asked, if you identify the replacement property within 45 days, but then later decide to back out of that property and it's after the 45-day mark, do you have a grace period to find another property?
This is that gray area. So the gray area is, this is what I tell my clients who pose this question to me, is that your intention is to cross your T's and dot your I's, right?
Mhm.
So if your obligation, you're trying to satisfy your obligation on this replacement property, and for reasons beyond your control, it fell through the cracks. And then the other properties that you identified, maybe they got, they got purchased by other people. So what do you do? Because you still want to satisfy your exchange. You don't want to pay that debt. My suggestion is that, not a suggestion, my option I give my clients is that you can still purchase another property, but you just need to know that there's a risk. So if you were to get audited by the IRS, they will say, why did you purchase this property? Explain to me, because you didn't cross your T's and dot your I's. So do you have a paper trail, or did you just say that, you know what, I just changed my mind and I didn't want that property? More than likely, they would overturn your exchange. Yeah. But if you have clear intention and a clear paper trail of showing why you did what you did, then they might uphold it. I don't know that, because I think it's case by case scenario, but you just need to know that if you do that, you're kind of falling outside of those safe harbors, and that you're now at risk. Yeah. So I don't know, just because you're doing a 1031 exchange doesn't raise a red flag. This has been around for over 100 years. So I think it could be random, or if you've been audited in the past, then maybe there's a higher chance that you would get audited again. I don't know. It really depends on everyone's own scenario.
And, I think the safe harbor, right? There's rules, the 45-day rule, the 180-day rule, the 3 property identified. So if you follow all the safe harbor rules, automatically, the 1031 exchanges is successful. Mm-hmm. Taxes are deferred. Mm-hmm. And so what you're saying is you might fall outside of the safe harbor, but
right. now you're carries a little risk. Right. Yeah. Right. And I want to say, because I didn't touch on this, but if you're past that 45 days and the property falls through the crack and you don't want to purchase anything else, I can't give your money back to you. I have to hold on to that money until your exchange completely expires. Yeah. So I wouldn't be able to give you those monies until the 181st day. So, it's a hard pill for people to swallow, but the reason is because I need to make sure that you don't show that you have control of your own assets. So my job is to act on your behalf. And if you're telling me to send money over here, send money over there, then you have complete control of your assets. So, I just wanted to quickly mention that.
And I think really one area that really trips people up is the 45-day ID window. Mm-hmm. They think going into it, right, 45 days, plenty of time. I got everything under control. And so they're pushing up against that ID deadline. Mm-hmm. They're panicking, right? It's one of the reasons why Millcreek Commercial exists, right? Like we have inventory ready to be identified. We had a call the other day. Oh, hey, I'm on day 42. Mm-hmm. This was Friday afternoon, right? No, I'm sorry. Yeah, their deadline was Monday. They call us, their real estate agent calls us Friday.
Probably in a panic.
4:45. My clients need something. Help. Mm-hmm. We in that scenario we can help, but also. A lot of exchangers say, okay, I'm under contract. I'm doing an exchange. I need to get like things rolling on the back end so that I'm not missing any rent, right? And so a lot of people kind of with us and hopefully other options, but especially with us, they can put us under contract, sell their property, a couple days later, close on their replacement property right away. But it takes some planning, and it takes a couple phone calls. It takes a couple, coordinating all that.
That is such a great point, because I think people think about the dollar sign and what it can bring into them versus like, what if my tenant moves out and I can't get another tenant for a few months? Can I cover that expense? With you guys, you don't have that issue. So you're not, you have reserves in place if that tenant eventually of course you can explain that, but for residential real estate, there's a lot of risk involved based on your tenants.
Yeah.
So I think that's a great
repairs,
point.
all that. Yeah. Okay. Dara asks again. So if you are exchanging a property with a loan, with a mortgage, you have to make sure the new property has the same loan or can it be a larger loan?
It can. So you don't want to take, like I said before, you can take on a larger loan, but you just want to make sure that you're still investing all of those monies as well. So
All the equity.
all the equity that
Yeah.
I'm holding for you.
Yeah.
And so if you're buying a property that's much greater in value than what you've sold over here, and you had a loan involved, then more than likely you are taking on a larger loan to make up that difference, because you only have X amount of dollars here, but you can increase your loan amount so that you can buy maybe a $2 million property instead of that $1 million property. So of course, in that scenario, you're satisfying that debt requirement.
Yeah. Okay. Brent asks, if selling multiple properties to the same buyer, like you're selling maybe a portfolio of rentals, right?
Yeah.
Is there more flexibility in the 1031 exchange if each property is sold in separate contracts versus one contract for the entire portfolio?
Well, I would think to delineate it, it would be better if each one had its own contract so that it is defined. That's how I would prefer it, so that each one has its own transaction. That's how I would prefer to see it done.
You recommend that?
Yes. Yeah. So that it's absolutely clear. I haven't really seen multiple sales included in one contract, to be honest with you, but I know it can be done, but that has never been my experience.
Yeah.
But I would say keep it clean, keep it separate.
Okay. Thank you. An anonymous attendee asks, please elaborate more on the case where the investor does not want to be a landlord any longer and can choose to have less headache by getting into some sort of a commercial property, right? How does that work? Doesn't commercial building require landlording property management to deal with tenants? So yes. And I think when most of us think of commercial, we think of office, multiple stories, or strip malls, multiple tenants, different doors, and, in that scenario, every tenant has basically their own unique lease. It's not always cookie cuttered across every tenant, right? The terms, the rate, everything, the price per square foot. And so that can be very complicated and usually require like a little more sophistication, leasing agents and all that sort of thing, right? We think that's more complication than we want. So we like the single tenant buildings, one tenant, one building, right? A long-term lease, lots of stability if there's a long-term lease. We like a corporate guarantee. So it needs to be a strong enough tenant that if they ever shut down that certain location, they're going to continue to pay rent because they have every incentive financially and their credit rating. Yeah, we're going to pay that rent even though we shut it down. And then we love the triple net leases, or as close to a triple net lease as we can possibly get. I mean, kind of those three, if we can hit 3 or 4 out of the 4 or all 4, that's like the bee's knees, right? Easy to operate, easy to landlord. I think you get the highest return relative to work required by the landlord. So those are the properties that we kind of slice up like a pizza and can sell you a small portion of, a Family Dollar store, right? Or a surgery center, or a early childhood education center, right? Something along those lines that kind of take the headache out of landlording, kind of take that headache away. It's what I would put my grandma in if they were still around. If my grandma's like, oh, help me get into commercial, grandma, this is what we have. This is what I would recommend. And then she'd tell me to shut up and she'd make her own decision.
But how much is it like a minimum requirement to get into one of your deals?
Low, like 100,000. We pay for title insurance if it's over 100,000. We can accommodate under 100,000, but the buyer is required to pay for title insurance if it's under 100,000.
Right.
I think the lowest we've ever done was like $22,000.
Yeah, I think that's important to know, because I think people are under the impression like, I can't afford a multi-million-dollar property, even if it's a standalone property, it's still worth millions. How do I do that? And I don't think most people, most real estate investors know that they can get in for so little,
You
I
know,
think
yeah, so they're exchanging a home, 3-bedroom, 2-bath home in the middle of the neighborhood for that they own 100% of
Mhm.
to owning 20% of a single tenant building out parcel to a Walmart maybe or something, right? Like that. Busy corner, high demand, people passing through all the time, high visibility, and kind of the quality of tenant, quality of the real estate, the quality of the lease, all is heading upward, right? And so
Yeah,
that's why we like this class of asset. Easy to own, easy to operate.
yeah. I think it's a great option. You
Okay,
guys are
Brian, yeah, sorry, go ahead. What was that?
me.
Okay, so Brian asks, if I own $2.5 million commercial property and I owe $1 million,
Mhm.
would I have to exchange for a $2.5 million property, or can I pay off the debt and trade it in for a $1.5 million property?
You can do that. You're just going to have a taxable event.
So
So
to defer all taxes, what must he do?
you need to look at another property that's valued at least $2.5 million. You can break that up. So you can buy multiple properties that adds up to the valuation of $2.5 million. And that debt requirement, that $1 million, you need to take on a new loan of at least $1 million that maybe is spread throughout those. If you're buying multiple properties, it's spread out throughout those properties. But you need to make sure that those three factors that I talked about, the value, the debt, and the cash, those all three are equal or greater in that purchase. If they're not, that's okay. Maybe it's okay for you, but it just means that you're creating a taxable event on some level, whether it's the value or the debt or the cash.
Yeah.
So some people are okay with that because maybe they have other losses that offsets the gain over here. So maybe they're talking with their tax advisor, where their tax advisor is saying, you can buy down. I don't think that you'll be hit with taxes as much. And I think that'll be okay. But I would if you're planning on doing that, then I would highly suggest that you crunch those numbers with a tax advisor to see what your tax liability is.
Good. So Amir asks, is the wait before conversion 2 years or more? And I think what he's asking is, if I buy an Airbnb, how long do I have to wait before I convert it to my personal residence?
I think to play it safe is to hold on to it and report it for at least 2 tax periods. So have at least 2 returns that are showing proof, solid books. And I think that's another gray area where I think, certain advisors have their own interpretation, but I think on average that playing it safe is to have the mindset to hold on to it for at least and report it for at least 2 tax years before you decide to exchange it or convert it.
Yeah. David asks, when can you do a 1031 with a mobile home?
I just had a client ask about this. And before, it was like, as long as the home is affixed to a foundation, it's not registered with the Department of Motor Vehicles, then that's the only way that it'll qualify. But now that is kind of lessening. So now the tax advisors that I work with, they're saying as long as it's considered a dwelling unit. So what does that actually mean? And I think it still needs to be affixed to a foundation versus being strapped so that it's not really mobile. But if it's a dwelling unit that you can safely live in and receive benefit from, then more than likely that mobile home will qualify. So again, I think it's really, because I still think it's a gray area, I really think that you should still get a legal opinion on whether or not they think that qualifies for a 1031 exchange.
So kind of the differences here is manufactured home, mobile home, versus like living in your Winnebago.
Yeah, right.
You're saying the Winnebago could be considered real estate? Is that what you're saying, or unlikely?
No, because it's not like a real estate asset where a mobile home is.
Yeah.
So the Winnebago is still personal use. It's still, you're using that for your own personal gain. But the mobile home, I mean, it does seem like it's real estate. It's just because technically you could pick it up and move it, where I feel like in the years past, it needed to be in a fixed real estate asset. Like it needed to be fixed to the ground in order for it to qualify. And now pertaining to like manufactured homes or mobile homes, I feel like that has kind of become less gray. And now they're saying that if it's a dwelling unit, you know, that seems like it's real estate, then it would qualify. So does that make sense?
Part of the definition of real estate is something that's affixed to the property is difficult or impossible to move. I mean, a mobile home is difficult to move.
Right.
Very difficult. Anyway, Okay. Cheryl asks, is there a record that I can review this 1031 exchange? I don't know. I'm not entirely sure what she's asking about, but
like the actual statute, you can find that irs.gov.
I've read it. It's
isn't it fun?
I would, part of me wishes they would put a little more flavor in there, but they got to keep it real.
So I'm not sure if that's what she's looking for, then
But
it's,
I mean, all the rules are written down. Maybe spend a couple sentences on like, what are the rev procs? What were the purposes of the rev procs? And, all the rules are written down.
right. So the rev procs just kind of define certain areas that were gray. So like the rev proc were pertaining to natural disasters. They kind of had to define that. Like this is the only time where you would get this extension is if this happened. The same thing with reverse exchanges. They created a rev proc back in 2000 to define how you can do another type of exchange. So you have your statute, but within there, you have some other parameters of how to go about the 1031 exchange.
Yeah. And anyone can read them.
Yes.
And some people love to read them.
Sleep?
Yeah. Okay. Kevin asks, on your taxes, can capital gains be offset by business losses in another entity or property owned, including depreciation?
So I'm not
Ask
the
your
tax
CPA.
advisor. Yeah, that's
Ask
the
the
tax
CPA,
advisor to see what you can and can't do. Sorry, Kevin.
Okay. Nancy asks, what if you are only one member of an LLC investment property and want to sell out, but the rest of the members don't want to sell? How would that work with the requirement to dissolve the trust or LLC, since the rest of the members do not want to dissolve it?
You'll have to dissolve. Oh, so maybe they buy you out.
They can buy you out.
Yeah. Again, it takes tax advice to do that. I don't want to I don't want to put words in my mouth on how to structure that deal, but I would get, unfortunately, a legal opinion to see how you can pull yourself from that.
Yeah.
Maybe you can just dissolve your portion. I'm not sure how the legal team would go about doing that so that you can move independently from them.
Yeah. Okay. Moya asks, I live in my primary residence for 2 years and moved into a 2-family residence.
Okay.
Maybe like a duplex. I want to sell both to buy my retirement home, and I can avoid the 1031 taxes. Am I clear from the taxes on the first property? Again, anything to do with taxes, how much taxes are owed, what taxes are owed.
Mm-hmm.
I just point people, look, talk to your CPA.
Yeah, I never get into specific.
Yeah.
I never crunch numbers when it talks about tax liability, because I just won't even take that responsibility because it's not my realm. But for her scenario, I kind of touched on it in the very beginning, where you can still sell a whole, like a duplex, if you're claiming part of it as your primary residence, you get your own section 121 exclusion that pertains to your primary residence, where you can defer up to $250,000 of the gain or $500,000, depending on how you file. And then you can do an exchange with the other portion. So you're still selling 100% of it. And it's possible that you can defer all of the gain. I just don't know how much that property has appreciated over time. I don't have that information to answer this question with 100% certainty, but it is possible that you could defer all of it and still do part of an exchange and sell your primary residence.
Okay, Will asks, once a person sells their commercial property, they are interested in placing their money as equity in to a larger commercial property, right?
Okay.
For example, the person has money that they want to be part of an investment.
Mhm.
Friend needs equity to build their capital stack to close on the new property. Can that person give their money as an investment 1031 exchange?
Well, I mean, you can't give it to your friend because it's almost like a gift, but if it's going into like, this is how I look at it. Like, is there a closing officer? Is there a contract in place? Is the property defined as an address?
Yeah.
Right? Like, is this an investment property versus giving money to a transaction where it's not even built yet? It's an investment down the road that wouldn't qualify. But are we closing on a property that's built today?
Yeah.
So I'm not sure that I'm 100% clear with Will's question, but
I mean, even like a REIT, right? They have
Mhm.
the bank account that accepts the funds, and their company owns all these different assets, and your money goes in and it's commingled
right.
with everything,
Right,
not
but you're-
1031 exchangeable.
Right. And you're not getting a percentage of ownership. You're not entitled to any of those assets.
Right.
So that wouldn't qualify. So it kind of depends on what asset are we talking about here to make sure that aspect qualifies for the exchange.
Okay, John gives us a situation. A hotel property and the operating entity is owned by a single S corp.
Okay.
I just want to say, okay, this is already a question for your,
Right.
but I'll keep going.
We're talking about corporations. Go ahead.
I'm interested in selling via tax-free exchange about $12 million of stock in the S corp. The economic work well. Okay. Is the S corp stock a possible tax-free exchange target property? So I think what he's asking was, can I exchange out of when I sell a company, can I exchange? I think that's
It
kind
needs
of
to be a tangible real estate asset. So
Yes.
it can't be an investment of a corporation that owns other assets. It needs to be the actual real estate asset itself in order for you to receive the benefit.
Yeah.
I like him trying to think outside the box.
I know.
Appreciate that.
Nancy asks, can you explain why investing in REITs is not acceptable? We kind of just went over that, but if there's anything else you want to add to that question.
Well, I mean, okay, so I don't really know enough about it, but there are these 721 up REITs. So I feel like they're assets for people who, it's not a 1031 exchange, but you can take a real estate asset and then do a 721 exchange into what eventually becomes a REIT. It doesn't qualify for an exchange because you can't exchange out of it. So once you kind of go into this up REIT, you can defer the gain going into it. You just can't get out of it. So the way that any REITs are structured, it just doesn't work for 1031 exchange purposes. But
Yeah.
So you can get into them on your own. You just can't take your investment asset and do a 1031 exchange with it.
Okay, what happens to gain on tangible personal property within a 1031? Is there a rule of thumb to defer gain, for example, less than 15% of total sale?
I don't deal with personal assets in a 1031 exchange. There are other companies that might handle that, but for me, I don't. It becomes way too complicated. So I'm sorry that I can't answer that question for you.
Sharon asks, if the vacation home is owned by the LLC, if you paid the LLC for those days that you used it, couldn't you use the vacation home as a renter? So I think what they're saying is,
the box.
Yeah, if I want to use my VRBO and I pay myself to use it, will that count against my 10%?
I don't think so, because I think you're trying to, you're paying for your own property.
Yeah.
So it's kind of silly, but I think that's a way that you're kind of thinking outside the box of how can I get around it so I can use my property more. So I find that interesting.
Yeah. Anonymous asked, does your primary residence have to be owned by me, or can I be a renter as my primary residence?
I don't understand why you would do that, but it all boils down to how you're reporting the property for tax purposes. So
Yeah.
if you're reporting the property as your primary residence, that's where you're living. If it's
Right.
not, then you're either renting a property and you don't have a primary residence, or it's the primary residence you once had isn't your investment property
Mhm.
or your second home, and maybe you're renting elsewhere, you're still not claiming a primary residence. So it just depends. It all boils down to how are you reporting your properties
Yeah.
for tax purposes.
After we finish, there's a couple more questions, but Megan, we'll have you provide your contact info
Okay.
after we kind of wrap this up. Once a person sells their commercial property. Oh, I think that was a double one. Okay. Rashish asks, I have a single family rental that my family and I have been living in for 15 years. What do I need to do today to make the property eligible for a 1031 exchange?
And my first question is, how long are you living in that single family rental? So are you moving out when people are trying to use it? So is it
Well, maybe SFR means single family residence.
residence? Yes.
So so they have a home. They've been living in it for 15 years.
Okay.
He's asking what steps does he need to take to make this a rental and turn it into a 1031 exchange?
That's a great question. So it would be a matter of, you could start renting it out. And then you're keeping track of all of your income, basically your P&L statement, your profit and loss, and then you will report that for tax purposes. So I want to make sure that you're reporting it as an investment property for, I like to say, a minimum of 2 tax periods.
Mhm.
Other people might say less than that, but I think playing it safe is 2 tax periods before you decide to do an exchange with it. So you want to make sure that you at least have a few years of rental income under your belt, and you've reported it as an investment property during that time, and then you would be exchangeable.
I would say talk to your CPA. But if you've lived in it any 2 of the last 5 years and you're going to have less than $500,000 as a married couple in gain, you don't need to turn it into a rental. You can sell it section 121 and sell that without paying taxes on the gain.
Right.
Yeah. So just touch base with your CPA. In a scenario where you bought something for 200,000 and now it's worth $1 million. Okay. Then I would say, yeah, let's explore turning it into a rental.
Right. I think, yes, that's a great point. You want to make sure that you're talking about your options ahead of time, which I think is great. It sounds like they're doing their research, but yeah, you want to figure out what's your goal, what's your real plan. That's information that I would want to know ahead of time.
Well, we've gone through all the questions, Megan. Thank you so much. It's just been a pleasure to pick your brain and learn from you and realize, number one, we could use some strategy thought around how we kind of manage our own portfolio and work through the potential gain, like potential benefit, and be aware of the potential kind of downfalls that if we don't make kind of the right decisions that.
Yeah, I just think that there's a lot to consider because, like, how can I increase my monthly income? And maybe I want to move markets, maybe I want to invest in an area that's more affluent, maybe in a better school district, because then I'll get more solid tenants, so there's so many different reasons that people would enter into an exchange, and for various reasons.
So if someone would like to get a hold of you, Megan, what's the best way for them to do that? First, I would say go to your Instagram page because you're so clever and you're so full of education and entertainment. I just love it.
I like to have fun with it. So I do. I have so much fun with Instagram. If I can take a boring conversation and make it fun, I'm all about that. So.
So funny. So here's your contact info that people can have. And
you can call me, text me, email me, whatever you're comfortable with. So I'm readily available.
Thank you, Megan. And as a reminder, this will be made available as an on-demand webinar for those that wish to come back and visit it. We thank every single participant who joined us. Thank you so much. It's been a pleasure. if you have questions, call Megan. Ask her. There's no question too small, too dumb, too insignificant. She wants to help you, and she
Yeah,
exudes
and
this.
I get
touch.
people who are like, do you have the name of an attorney or an accountant that I can talk to? So I can, here's the interesting thing. And I just want to add this. Not every accountant knows the ins and outs of 1033 exchanges, and not every attorney. So you want to make sure that your attorney knows the guidelines, is fluent in that conversation. Otherwise, they're not help to you. You're going to end up spending more time for them to do the research.
Yeah.
So I do have a few good resources. I would say like only a handful of reliable resources where people, an accountant or an attorney could give you solid advice.
Yeah.
So
wonderful. Thanks. Well, we'll close out. Appreciate everyone for joining us, and thank you for your great questions. And Megan, thanks again.
thank you. I appreciate it.